From all metrics so far, there is no indication of a recession.
Redfin and Graham Stephen are lying to you. It's not a matter of if the housing market crashes, it's a matter of when. When and how much. Stay tuned, because in this episode of Midas Markets, we're going to be going over how the big media and the big housing stakeholders are trying to take advantage of you. They want you to take out loans. They want you to go bankrupt. The big banks are just going to eat up those banks with the defaulting loans. They want you to keep buying, thinking there's a housing shortage. In this video, you're going to see why that's not the case. There is no soft landing. Get ready for it. If you've been watching the news, you've probably seen a lot of stuff like this. Housing shortage, where's the bottom? Redfin CEO says we've hit the bottom, soft landing incoming. But how certain is this soft landing that everyone is so certain that it's coming? In history, we've only had one soft landing. Literally just one. I'll show you right here on the charts. Yet somehow, CNN, Google, everybody, every single link you'll find on the internet, almost 90% of them will say there's a soft landing coming. There's a soft landing coming. All these money managers, top hedge fund managers, everybody, they're all saying the same stuff. We're coming. Soft landing is coming, guys. The Fed's doing good this year.
To Jerome Powell, the economy is gearing up for a soft landing in 2024 because inflation is largely under control, GDP is strong, and consumer spending is robust.
I don't hold it against Steven for his views that he just doesn't have enough data. He hasn't researched his videos enough to know what's going on. So the Fed says that we've had 3 soft landings in history: 65, 84, 90, whatever, 94. And out of those, I'll equate that there's only actually been one soft landing in 94, which the circumstances were completely different now than they are then. And one in a history of over 100 years, that's a pretty bad track record, if you ask me. There have been significant differences between what we saw in the 1990s and what we're seeing today. In the early 90s, we had, the fall of the Berlin Wall, the end of the Soviet Union. Global trade is booming. We have NAFTA originating in 94. NAFTA, the North American Free Trade Agreement. You can see there's big issues in comparison to today. So the soft landing was more attributed more to those global trade initiatives being, just good fortune, just out of good fortune happening, that resolved in all these this global economic trade expanding. Today we have the exact opposite. We have the war in Ukraine. We have this research report over here by Northern Trust, which states the effects of the interest rates are being felt by countries like Argentina, Brazil, Egypt, Russia, and these effects, they're the exact opposite of 1994. So we're seeing global macroeconomic troubles. We're seeing China, high unemployment rates, 40,000 people lining up for one job. It's the effects of the rates are being seen all over the world. Now, we talked about the macroeconomic effects. We talked about the rate hikes. Let's talk about the supply and demand of the housing market. Where are we at right now in the supply and demand cycle? First, let's take a look at the demand. U.S. population growth, it's at its lowest it's ever been since the Great Depression, at just a 0.5% increase in the population. It's only 1.5 million people. We're building that many houses right now. So does every single person need a house to live? No. The average people per unit is about 3.5. So we're building right now 3 times more than we actually need for the amount of people that are being born. And let's not forget the shadow inventory. So we take a look at Wolf Street research, which takes census data and all this and various different kinds of economic data. We see that there's 15 million houses in shadow inventory, housing stock, which is houses, condos, apartment units, and that's just housing being held off the market for plethora of reasons. Being rented out, being renovated, second and third homes, and probate and divorce filings. Just 20% of these houses hit the market. There could be a huge glut in inventory. especially with the slightly lower interest rates. It will increase inventory dramatically. We'll have, the shadow inventory. We'll have sellers wanting to sell, and we'll just have, a buyer's market, especially with the slightly lower interest rates. It will increase inventory dramatically. We'll have, the shadow inventory. We'll have sellers wanting to sell, and we'll just have, a buyer's market. Currently, we're seeing record low sales and record low mortgage applications. We haven't seen this in decades. If just 20% of these houses hit the market, with the increased supply, with the, the higher unemployment that's creeping its way through the economy, there could be a huge glut in inventory. With slightly lowering interest rates, pressuring sellers, to sell, bring more inventory out of the sidelines. It could be huge. Currently, we're seeing record low sales and record low mortgage applications. We haven't seen this in decades. Now you might be saying, but Pete, the Fed says that we've had, and the Fed and the CNN, they said that we've had 3 soft landings. Say we had one in '65, in the '80s, and in '94. Well, yeah, that's not entirely true. As you can see, in the 1980s, we had a sharp sell-off in the stock market, almost a 50% drop in the stock market. In the early 80s, what they said, we had a soft landing, and in major metropolitan areas, we had almost 40% drops in the housing prices. So maybe most of the areas only stayed the same or went down a little bit, but a lot of areas where you can see what the research says is where the bubbles have gone up dramatically. That's where the price crash has also crashed dramatically. And since right now most of the countries in the bubble, we can expect that most of the country is going to crash, like similar to '08, similar to '01, maybe similar to the Great Depression. But I don't think it's as bad as that, where prices crashed 70%, 60%. When it comes down to it, when rates are higher, people hire less, unemployment goes up. It's how it's always been. Might have not been that way exactly in '94, but every single other time it's been that way. Take a look at this chart and tell me what you guys think. It's pretty clear if you look at the data. If you look at the data doesn't lie. One of the most worrying data points is the decline in rental occupancies and rental vacancies upticking. That's crazy. So this is one of, not even during the Great Recession did we have rental vacancies picking up. So less people are buying houses, rental vacancies are going up. Where are these people going? Are they just moving in with each other? We're seeing the trifecta: decreased mortgage applications, decreased housing sales, decreased occupancy and rentals, all the way around. We're seeing decreased rental prices month after month after month. Supply is increasing. Supply is increasing, and you haven't even realized it yet. So don't get suckered in. That's the main point of this video. Don't get suckered into the headline news. Headline news is not your friend. With all these data points, the culmination of all this research, what the future has to bring us with AI, robotics, displacement, companies are going to be wary to take on new employees in this higher rate environment. Even the Fed is going to be too slow to lower rates. They always have, they always will be. They just don't look at the data. They just don't look at it fast enough. Greenspan, he's probably one of the best that looked at it the best, and that was the one time in '94. The Fed we have today is just not quick enough, does not respond quick enough to economic changes. And who knows if this is an accident, if this is on purpose, who knows. But from the culmination, this is what we have to look at. This is the data. This is the reality we're facing moving forward. Tell me what you guys think. Remember, if you guys want real news, come to Midas Markets. I have a free Discord group down below where we make low risk trades in the market, do credit spreads, far out, far high, try to beat the market that way. You could easily make a few percentage points a month. Just if you know where the market is and you know where the money is going and where you expect it not to go. Thank you guys for watching. Please let me know what you guys want for the next video. Stay tuned, and information down below. Thank you guys. Link, like, subscribe, follow.